Hi, I'm Brian Spinelli, Senior Wealth Advisor and Chair of the Investment Committee for Halbert Hargrove. I wanted to discuss a common question that we get in environments like these where markets are down. And one of the common questions that may come up in client meetings is, should we be making any changes at this point? One of the things that I would like to go back to is that as a firm and what we've been doing with our clients over the last few years is building in diversifiers to portfolios. And in most cases, depending on your life phase and where you're at within your investing time frame here, we've already made changes prior to coming into 2022 to further help with risk controls. So depending on where you're at, you likely would have cash built up already in the portfolio coming into this year, and you would likely have been using some forms of alternatives that are not tracking to stocks or bonds, simply trying to find diversifying return streams that help weather periods like what we're going through better right now. So we as a firm have already been making changes prior to coming into this calendar year, and your team at Halbert Hargrove would be happy to discuss those with you in more depth. One of the other questions is, with the way stocks have behaved this year, stocks being down anywhere from 15 to 17%, depending on what you're looking at. One of the common things is that this is different. It's really not. This is not out of the ordinary for stocks to behave this way. And in fact, going back over long periods of history over the last 40 plus years of markets operating pretty well, on average, in a calendar year, you should expect roughly a 14%, 15% drawdown at some point in the calendar year. Now, that doesn't mean the market finished negative for the year. It just means that was the price decline that was experienced at some point within a calendar year. But on average, when you look over those same time periods where you get an average of a 15% decline, 75% of the time markets finish positive for the year. So it's something to keep in mind that this is not out of the ordinary for stocks to behave this way. And that's also part of the reason why stocks generally offer higher rates of return to compensate investors for the volatility they have to endure over short time periods. The other asset class that has endured a different period than what we've experienced over the last 40 years is fixed income or bonds. And for bonds this year, depending on which measurement or index you may be looking at, bonds on average could be down anywhere from 11 to 16% at this point in time. And that really has not happened in the last 40 years of looking at the bond market in particular. However, if we go back to 2021, investing in bonds on a forward-looking basis was offering anywhere from returns of 1.5% to 2%. We have now gone through a major adjustment period on bonds where they're now offering anywhere from 4 to 5% on high quality bonds, and you can even go out a little bit further on the risk spectrum and earn upwards of 7 to 8%, depending on what you're looking at. So within this calendar year, bonds have priced in quite a bit of forward-looking rate increase expectations. They've factored in a number of things like inflation expectations. So being a person entering into more bonds at this point might provide some opportunities as well. I hope you found this helpful today. It is a general topic. If you want to get into your specific situation and what your team thinks about it, please reach out to us and we'll be happy to address these topics in more depth. Thank you for watching, and we look forward to hearing from you.